Well, hello everybody. It's November 15th. It's the weekly review where we take a look at what happened, what we can expect for the coming week or two, and what we should or shouldn't do about it. Last week, of course, we finally got that retrace. So, you knew it would come. It was just a question of when. It was also a question of how much. And when it did come, it came back fast and furious, as you see. 4.5% on the Russell, which was the worst case, 3.5% on the S&P, which was the best case. So all in all, pretty big hit, fast hit, and we'll look at what that means as we go along here. So let's take a look at the quick review. After a fantastic almost 6 week run, the market finally retraced, came back with a vengeance. All the short-term bearish ABCD structures more than completed to the downside. And what I'm talking about there, of course, is the ABCD structures that we had talked about that may or may not take place, and those that did take place more than completed to the downside. So if we look at it here, there's a small ABCD structure. These are all on the daily charts. They all projected down, most of them into the areas of support that we expected. Like in this case, the support area was in this zone here. It came all the way back into that area and actually right to the bottom of it. And so they all extended beyond where they projected to. Like here's the S&P 500, about 0.86 more than it was expected. The NDX, or actually the NASDAQ composite, 1.5% more. The NDX itself, 1.3% more. And on the Russell, 2% more than was projected on all those ABCD structures. So that is done. It's already happened. And, now we have to look to, what's next off of that. The gaps were filled as well. So if we look at we'll just take the NASDAQ. That's the one I'm probably going to be concentrating on mostly today. If we take the NASDAQ and look at it, on the NASDAQ, we had that, that big gap up off the trifecta earnings back here. When Google, Amazon, and Microsoft reported, and that was after Draghi had already driven it up that prior day, you had it gap up. Well, that gap up, both in the case of the NDX and the NASDAQ, now has been filled. It's come back. It's filled it completely. And that also is a situation that, usually does occur at some point, and in this case has done so. Another case or another item in terms of a quick review is the actual 40% pullback. I mean, if you look at this, and I didn't do the actual calculation, but a lot of people do fib numbers. That's about 40% of the move. If you kind of divide it up into 5 areas on the way up, you can kind of see them. You're about 40% of the way back now, and the fib numbers that people look at is like 38.2, I believe, on the fib retrace, and so that in terms of a pullback, and the reason for bringing it up is it's about what you would expect, right? It's come back about where you would expect it to on that first level. And finally, if we switch back over to the ideas, the intermediate term time frame reads, if those are correct, then this is where we should see some buying come in. And what I'm talking about, of course, is that, we had, go back and review here. We had breaks of swing point lows. Actually, this is the NASDAQ, so it wasn't that low. The ones on the NASDAQs were just the higher ones, which were up here. And so we had breaks of swing point lows, and we traded back up above those for 2 bars on the NASDAQ on the weekly time frame. That pretty much tells us that more than likely, what was a downtrend, right, turned more because of that, turned more to a sideways trend. And so if that's the case, right, then we should see buying come in at some point off that retrace when it finally occurs. You see this zone right here. This is where the NASDAQ weekly is expecting it. Of course, the other big bar would be the top of this bar. So somewhere in this area is where you would expect the buying to come in, and we'll look at that in a little more detail here in a moment. As far as What happened, unfortunately, over a weekend in Paris, the terror attack, more than likely that's going to put some sort of pressure on these markets when they open to start the week. But typically, that has not. Typically, it's been bought, not sold, for some number of years now. And I suspect this is going to be the same case. Unfortunate, terrible incident. But as far as the markets are concerned, I don't think it's going to make a huge difference with what we see. The technical picture, we knew, and I guess I could spell that right, KNEW, a retrace would unfold at some point. And though I thought it was going to be likely last week, it took another week to actualize, and that retrace came fast and furious. The good part is that volume was ordinary, and the pace of the decline was fast. So if I pull up the S&P 500 here, on the daily chart, you saw a little bit of volume rise on Friday, but it's very normal. I mean, just look back into the bar that it got over. You're doing 44.3, you're doing 42.7. So you're coming back with normal volume. If you go back to the larger bars, it's quite a bit less volume. Those bars on the way down over here, quite a bit less volume as it comes back. Now, on the S&P, of course, the place it's trying to come back into is here. That's the swing point high. That's the retest regen. It's already tested it once. Is that true? Yeah, it tested right here. And so this is the second time back. So on the S&P, the odds are not great that that's going to hold, but that's not the case elsewhere. If I pull up the NASDAQ composite, here we have actually the first retrace after the breakout. If you take that swing point high and bring it over, you're into it. The probabilities that this holds are extremely high, and by hold it means that it holds this price point on a closing basis on the first retrace. Typically, you'll get some sort of a sideways worst case, but a bounce out of it more likely. And so you can almost blindly buy these kinds of retraces on the first time back. And the reason that it's such a high probability is it traded more than 6 bars on the breakout without a retest. Looking at the other items, we've already talked about the ABCD structures done. I just talked about the regens, retest regens, likely here on the NASDAQ, the NDX, probabilities, of a failure less than 10%. On the NDX, that's a long way back though, because if we look at it, it still hasn't even got to the swing point high compared to the NASDAQ. So if I took kind of what I think is the worst case this week, at least in terms of the retest regenerate, I would think that the NDX tries to pull back into the top of that swing point high, whereas the NASDAQ itself does a full retest and regen, and so that would bring it back into into the bottom of this area here, which is a little bit farther down, about 1% when you do the numbers. So that's the way those things set up. Another % there. The seasonality, of course, is still favorable up until January almost. There's a few little periods that are not as good, but in general, positive there. If we look on the negative side, rotation just not happening, right? We saw the same situation that we saw back in February, and so if I go back to the NASDAQ chart, back here, October made the run, of course, and then here was the push. If you remember, right, we had the push up here, and then kind of sideways stumbling, although higher on the NDX. It was really just sideways on the S&P 500. Eventually the big pullback, right, then the bounce, and now you get another pullback, and I expect you're going to get some sort of a bounce out of here. Whether it takes us to new highs or not is going to be the question, but that's the way this thing is trying to set up. The bad part, which is what we're talking about here, is that after this push up back in January, right, or January, February, that push up, we did not see rotation. And as a result, this market just couldn't climb. The whole market couldn't climb, even though the NDX and the NASDAQ kept trying to push higher the whole year. You saw stagnation almost everywhere else, and that's because we didn't see any of that rotation. So again, so far, no rotation. Most of the TATA support zones are still a good piece lower on the weekly charts. So if we just take this one and look back, The NASDAQ itself is right there, but if I look at, say, the S&P 500, here we can see quite a ways to go on the daily, quite a ways to go on the weekly. So, it's we have seen extremes, and the reason I say this is because of this fact, right? We have seen extremes both up and down. Can we get another somewhat extreme? I don't know that it would be extreme, but it would be a significant price point to the downside still. If you take the top, that's about 60%. Again, if you went to the full fib on the way back, you'd end up with a 61.8. And that's probably about right here. I haven't done the math, but I suspect it's in that area, maybe a little bit lower. And that would be a fairly serious retrace off this move. And given that we've seen these kinds of moves up and down, we can't rule that out as a possibility. So that's a risk on the downside. Another risk is high yield bonds. These junk bonds are heading back to the lows. And there's an article here, if you want to read it, talking about the kind of moves that have been made. But there's no escaping the fact that as this market pulls back, the junk, right, gets sold. And the whole premise behind it, of course, is that these companies that have issued this debt have a higher probability of failing on that debt. And so anytime there's worries about the economy, about the market, those bonds typically get hit compared to everything else. And the thing that's kind of amazing here, and maybe not amazing, but that certainly strikes one when they look at it, is you would expect this debt to get hit, but then you look at things that are not nearly as worrisome in terms of their debt structure, the investment grade corporate bonds, and they're still sitting at their lows. Look at it on a weekly. I mean, they came off back at the beginning of the year, April timeframe, came off, never recuperated, came back into a swing point low, failed, now tries to regenerate to the downside. The only good thing here is that this high corporate quality bonds actually did a bullish type action this past week. After selling down hard, they get under the lows and they hold. So it suggests that at least, on this debt structure, it's going to try to go sideways for a while longer. We'll have to watch, the credit spreads on the junk compared to the Treasury debts, right, to see how they either flatten out more or try to go negative. So that, of course, is another concern. The high quality debt still sitting at the lows, and the dollar continues to hang up here at the highs. So you've got strength in the dollar. We already know that puts pressure on commodities, emerging markets, so forth. And as long as the dollar remains somewhat in this range, we're not going to see the huge pressure on equities. But when it finally breaks out up here, and I suspect it's going to at some point because it's showing, that it wants to eventually, then I think that's when we're going to see, more pressure come back on a larger scale. Back into the equity markets. And you kind of got these two ranges. It's in the top of the range. I didn't quite draw those out right, but that's fairly close. And it's sitting up here. It's broken these swing point highs. It's testing into that one. I don't think it's actually broke that one. And then you have the one at the very high. So you're about halfway up on the top range, and it looks to me like eventually it's going to make its way to the top of that range, and the repercussions of that we'll see fallout in various sectors as a result of that, as we've already started to see. One thing I would note is that gold is actually trying to be an exception now. If we look here on the gold market, we can see that it came down to test this low where we had a lot of volume. I'm on a weekly share chart here. 103.43, you get into it, you get under it, 103.04, you close over it. You do 20.4 versus 50, right? So half the volume on the test. That tells me that gold probably is going to hold this bottom for now, come back up, retest into this area again. Remember, it was trying to do a bearish retest, regenerate to the downside. It had tested into it twice, here and here again, got right to the top of it, and then, of course, got the big sell-off, but still doesn't look like it wants to break quite yet. and actually get another bounce, and then we'll see if it's going to try to break or not. So gold actually is trading differently comparatively to the rest of the market in terms of commodity space. And then that also, if you look at the GDX itself is down here holding well above its lows on a weekly and on a daily. And that to me is another sign of some sort of strength probably coming back into these. And so for the gold miners, the gold itself, it looks to me like some sort of a counter trend bounce is probably going to develop out of this again. Fundamentally, we expect to see more interest rate reductions, QE talk in action pretty soon. Even with what's happening now in Europe, I think there's going to be even more pressure on Draghi to actually ease and put more quantitative easing at work. I suspect you're going to see the same thing in China, in Japan, in other places. And so that whole story continues, and that has been probably the biggest fundamental positive for years now, and it doesn't look like it's over. On the negatives, the rate hike, as the U.S. looks to the other side of the equation, that rate hike is still being priced in. It looks like there's a lot of disparity in some of these instruments, both domestically and around the world, and I suspect it's going to take a long while for those things to unwind. So in other words, like emerging debt markets, they're the ones that are denominated in dollars. It's going to take a long time to unwind those and hedge those. And so trades are going to be put into place. The currency situation is going to be put, the hedging there that takes place. All those things, we're talking about big money. It's going to take a while for those to actually play out. What I expect, what we were looking at last week, what I expect in the coming week. Last week I was wondering if the rotation would actually step up, and would we see that support any kind of a, some sort of a pause. We knew we were going to get some sort of a pullback pause. The question was, would we get the rotation, and would that, help this market to go more sideways than down? It didn't happen. It was less than I was even expecting, and I wasn't expecting all that much. But that was a big negative on the week. And then what kind of retrace? Well, it was deep, and it wasn't bought. And so on both counts last week, the more positive scenario did not play out. What do we think is going to happen this week? Well, of course, Paris is on our minds in terms of how it affects the market, let alone just the humanity side of it. And, will it be bought? I suspect it probably will, because that's been the characteristic of these for a while now. And you've also had all weekend to kind of absorb it, so the markets weren't quote-unquote shocked by it. They've had 2 or 3 days to think about it. So I think the action there will be somewhat muted. I don't think that's going to be a huge deal as a result. And then the real key this week is going to be the NASDAQ. Is it going to retest and regenerate? As it comes into that area that we were talking about on the daily time frame, is it going to be bought? And it's into the bar already. The test is to the bottom of the bar probably. That's 48.80 it looks like. And we're trading at 49 and a quarter. So we could see another 30, 40 points to the downside and still be within the bar. And, I wouldn't be surprised to see, given the kind of decline we got Thursday and Friday, I wouldn't be surprised to see it try to do a full retest and then regenerate back up. But that, to me, is going to be the key market this particular week to watch and to measure against. The odds heavily favor that they will buy it. On the economic earnings front, you got Fed reports this week, the regionals. I think as we head into December, I think those reports and into the Fed meeting on December, middle of December, I believe it is, those reports are going to be the key reports. So those are the ones that we really want to watch. So Atlanta, Dallas, so forth. You're going to want to see how those reports look at the regional activity, because I suspect that Fed is going to be leaning on those quite a bit. You got Fed minutes on Wednesday. I'm sure they'll parse that carefully. Fed speakers, again this week, there's 4 or 5 of them, but they've pretty much already been discounted because they're all singing the same tune finally. And there's a scattering of other data points, both here and abroad. What's the bottom line? Well, in my case, I think we have to look to both the short and the intermediate term time frames to consider what that bottom line is. On the short term, we're either at or fast approaching what is probably a bounce case at worst. And as I've said previously, those first retraces are likely to be bought, but I'm treating it that way. On the intermediate term time frame, and this is where it gets a little bit more interesting, we're still trying to decide what that longer term picture is. And so I want to focus just briefly here on what I'm talking about. So far that action today suggests that we've probably got some sort of a sideways market, worst case, on this particular time frame. And what I'm talking about there specifically, and I'm going to bring up the NASDAQ again, is that when we had those, what I showed a while ago, when we had those bearish retest regens, it was unable to hold them. Price got over them and held over them. And when that takes place, you have to respect the strength that has taken place on the push, telling you that no longer is it down, but it's probably sideways, right? It's probably going to go sideways. Now, the question is, what is sideways? And if we think about it, is sideways, is it all the way to the bottom of the range, or is it somewhere, in between or even higher? And on all these indexes, you can kind of divide this thing up in about 3 ranges. If I do this one, it's about here on the top one. And then you kind of have, one that's underneath that goes to about there. And then, of course, you got the bottom part of it. And so you're right here at the critical area where it kind of needs to hold on this range. Or, then, if you get into here, then you can expect it to try to get to the bottom of it. And that's different on each of these indexes. For example, the NDX, of course, is up here as well. But on the S&P, you're actually already into this second range. You're into the middle of that range already. And I think those ranges is where we have to look now at the strongest ones, because the weakest ones have already told us they can't hold. So we looked at the Russell last week. The Russell gave us a heads up that things were getting bad. And the Russell, of course, gave us that signal. And we haven't looked at the Russell today, but if we do, what we're going to see there is a pretty ugly sell-off, right, that took us right to the bottom of this bar, which is where we expected it to go to if it broke into it. Remember last week we were talking about if we get into this bar, then you have to expect it to try to get to the bottom. And that 1145 is exactly where it went, right to that, just like a heat-seeking missile. Went right to it, right away, 2 bars, you're into it. Volumes still positive on this time frame. If you look at it on the weekly, the volumes also were positive. You're back into that area. And the Russell, of course, being the weakest, never even got to the top of the range, right? The Russell's still stuck in this bottom part of the range and never has been able to get out of it. And so on the Russell, that's the area that you have to watch, because if you get into the lower part of the range again, you're going to try to seek the bottom. And so, here, all these indexes set up with 3 ranges, all of them in different places. Here you have to watch, can it get into that one? But now at this point, we've got the heads up from the weaker ones. Now you look to the stronger ones and ask, what are they going to do? Because they're the ones that are going to have to pull you out of this if you're going to be pulled higher. We don't know long term how this is going to resolve, but there's a few clues. NDX, it looks like they're going to try to test more to the upside. That resolution of those tests is what we don't know. And so if we go back, and I'll use the NASDAQ one more time, on a weekly time frame, we did everything you wanted to see the NASDAQ do. You got over the top of the breakdown bar. You got over the tops of the retest regenerates, right? You got over all those things you should get over, and now you're getting a retrace. All of that is normal. And matter of fact, that could be setting up some sort of an ABCD structure to finally get you over the highs. All of that, if you look at it from a positive perspective, right, all of that looks positive. You'd never know, though, is it actually going to take place? There's some clues that it probably will, but that resolution, of course, is unknown at this point. To make new highs at some point across all these indexes, like the S&P, is going to require rotation. We're going to have to see money flow into areas that it hasn't done so previously. And so far, even though there's a hint of that, For example, the financials, they got sold off this week just like everything else. As a matter of fact, if I scroll all the way down here, you can see the kind of damage that was done. Financials 3.5% lower. And so we didn't see any kind of real rotation into those areas that we were expecting or needing it to rotate to. And the two that held this market up and took this market up, which is the XLY and XLK, they were two of the three most heavily sold this past week. Of course, energy being the biggest one, as oil just totally crumbled. And so the rotation needs to take place on a longer term basis for this market to actually make new highs across all these indexes. We don't know if it's going to take place, but that's what we have to keep watching for to give us, a set of clues somewhere down the road. The most important thing in my mind is that it could take until summer of next year for this to completely resolve itself. And that's using the MTTFs to make that kind of a statement. And so if I pull those up, you can see it on all these sectors, on the indexes themselves. Almost all of these are sitting in bearish, right, on this time frame. You can see it here on the S&P at 25. If I pop that up and look at it, where can it go before it gets really extended? It's somewhere down in this range, about 32 bars. We're sitting on bar 13. That means you could go another 21 bars or so. That would take us, into the March, April time frame. So, if I look at it in knowing that we've gone to extremes, that suggests to me that we could go as late as May, maybe even June, before we see these things totally resolve one way or the other. And so, if I'm looking at this, I expect these to turn back to sideways somewhere between now and I would say maybe March, April, May at the latest, or the larger term top probably is in place. And so it could take quite a bit more time before we see the resolution of, the longer term time frame with respect to this market. So don't expect it to tell us, come January that this market's bullish again and it's going to go even higher. It may not be that. What we may instead see, when we look at this market, is what we may instead see is we may see some sort of a large range where we're testing the tops of the ranges, testing up here, maybe getting over it a little bit and then falling back into it. We may not see a resolution cleanly to the top side. We may see range trading for a while to go. And if that's true, then those long-term charts are going to get more worrisome. And if I pull one of those up, I'll just pull the NASDAQ up, the NDX. And what I mean by that, of course, is that we may see this just topping up here, never being able to make good, strong moves to the top side. And if that's the case, right, then you're going to see more and more of the probabilities, right, that some of these things set up to be even more problematic 3-4 months down the road, 5 months. So we'll have to see how it plays out. Right now, it's too early to know. It's just that, the point is that it could take a long time for this to actually play out before we know the ultimate answer. Last week, closed some trades. EUO took some profits. LAD, we actually got some profits out of that and then got back in it and got stopped out the very next day on some weakness there. Did make some ads last week, quite a few of them, as a matter of fact, as the market pulled back. CXO, this is in the energy space, and of course, energy was hit pretty hard. And my timing there, of course, wasn't nearly as good as it could have been. It did show some signs of life on Friday. Even though the space had been sold off heavily and this one had retreated quite a bit, we managed to survive the stop and, got a hammer reversal on it. So we may see this trade higher. If it does, again, we'll have to measure what the general market's doing. I would like to buy more of this, but I can't buy more of it on that third purchase, right, until I know that it's a good trade. And, even at this point, I do think it's going to bounce now, but I don't know if it's a good trade yet because you actually left a little bit more volume on the retrace than you did the prior 2 days. But it is a hammer reversal. Came into an area, had less volume, held, is going to try to retrace. Now it's the bearish retest regen on the upside, and so that's what we'll have to watch here, right, as it comes back into these two swing point lows that were broken. And so the key area is going to be right here. And so that's where we're going to have to make a decision about whether we push some of it back out or just hold on to it and ride it out. And my guess is that we'll probably push some back out and try to buy it a little bit cheaper. That's typically the way I try to trade these things. Going back here, CRE, Bank of America, these were both on the notion that we'll see some rotation. So far we haven't in that banking space. We have to give it a little time and see if it's going to develop. CPE did a secondary, unfortunately, but it held up extremely well, and so it's got me thinking that I do want to put more into this. The charts look great on this particular stock. You can see it holding up here, huge secondary, pushes price down, but it held reasonably well at the highs, and so I really like the way this stock is trading, and we'll try to put some more of it on. BMY, we're just trying to take some profits. IWM actually came back pretty hard, but came into the area that it should hold and did. Gold we already talked about, and so the trade there, of course, is to add DGZ on the retrace on that spread. FISV is a stock that just has this nice reoccurring revenue base. If we look at them, you know, they're up here flattening out. They came back down, broke a swing point low on Friday. You know, they could retrace some, but again, I think this is a long-term play. If you look at it, you know, the swing point high here is 84.85, and if you look at it on a long-term basis, this is just a steady truck to the north. And so even though I like this, I realize it could pull back quite a bit. If you look at those numbers that I put out on it when I went into it, you know, I'm providing for a lot of retrace capability here on the downside and averaging in on a slow basis. I've watched this stock quarter after quarter, keep telling myself I have to get in and keep forgetting about it. So finally I just pulled the trigger, especially with the idea that, you know, we may see some rotation into the financial sector. BMW, that was actually a pretty good buy. Still holding up there at the highs, still looking pretty good, but you know, we want to sell something up there and buy back. The two short trades on the currencies, I expect we're going to get some sort of a small pullback, and we'll want to add to those. ZLTQ, you know, this is my little small cap trade in a space that you know, has a lot of potential, but it gets pushed around a lot as a result of you know, being a small cap and a huge short interest in it. It came down on Friday. It's testing into these bars, which is the earnings bars. Doesn't have the volume, so I suspect at this point that more than likely, you know, this area here is the range it's going to try to trade in. So on the next trip down, I'll think about trying to buy into this area, and on the next push up into this particular zone, I probably want to try to sell some, right, on the ideal of buying it back cheaper as it bounces around. It's in the med space, you know, medical space, so it's having a hard time because that whole space is having a hard time. But if we see some rotation into that group, which we actually saw Friday, that of course supports this particular stock on the upside. Starbucks, what a trade this one has been, you know, up 25-30% on it for the year. Let me pull up the chart on it. You know, they had earnings that pretty much met expectations. They held up pretty much across that, even though they guided lower. But, you know, finally as we saw the retail space getting hit, this finally got hit, and it looks like we're going to get an attempt to buy this thing cheaper finally, after waiting for what seems to be months now for some sort of a retrace to develop on it after selling some previously. So all in all, I like the portfolio. We have a full house here. There's a couple other stocks I'm still looking at and would buy if they come back. You know, we want to trade them. We've got trading positions in place. We want to trade these positions. We want to accumulate on the longer term stuff and continue to watch on a long-term basis, you know, I should say intermediate term basis, how that rotation either does or doesn't play out, and how the NASDAQ behaves on this first bounce. Do we get a strong bounce and push back up towards the highs or not as we're into this seasonally positive period and as we come into the Fed meeting in the middle of December. So that's where we're at. Overall, I think this last week, it was, fast and furious to the downside, but in the context of going up, it was fairly normal. I don't think there's anything to be totally panicked about. But at the same time, we've seen extremes in this market. And even though we have evidence that we should see buying start to show up this week, we can't be guaranteed of that. If we don't see the buying, right, we could retrace as much as we saw this week. We could still retrace that much more and still be, quote unquote, positive on the market, but of course 3 or 4% lower. So, you'll see me take stops if this market doesn't find support. You have to. You can't just sit there. But if it does what it's supposed to, then we'll try to take some profits on the bounce and again, buy back on any type of retrace sideways type move after that. That's it for this week. Hopefully that's helpful. And, some of you have taken advantage of my offer, and that is, if you have a particular stock you're looking at and you want some advice or just my opinion, I'm always willing to take a look at it. It doesn't take me that long. Pop me an email. I'll try to help you out on anything that you're doing on your own. And as always, I thank you. Take care, and I'll see you next time. Bye.